Hey everyone, happy Thursday, February 22nd. It's about 11 o'clock on the West Coast and time for another market update. Getting right into it, going back to last Friday, we got January's producer price inflation, so the PPI. Different than the consumer, the CPI, the PCE, those are all consumer based on what we are doing as consumers. This is based on the people producing the goods that we buy. And that's been coming in our favor, but this time it did not. It was expected to go up for the month 0.1% and went up 0.3%. Year over year, it was expected to come in at 0.6%. It still came in at a really low 0.9%. But again, this is all about how the market's expectations, how they think the Fed's going to look at things. And so that didn't go well since we were expecting a lot lower. So taking a closer look, like I said, headline, month over month, 0.3, year over year, 0.9, still low. Core 0.5% month over month. That was a pretty big jump right there, half a point. And year over year, 2%, where I think I was supposed to come in at about 1.6%. And really the ones that really jumped the most, hospital outpatient care, portfolio management, legal services. Just hypothetically, the portfolio management and legal services, maybe that's connected to, such a great year in the stock market. Maybe a lot of the financial investment firms are adjusting their rates, for portfolio management. That's why, 5.5% jump in 1 month is a pretty big jump. So again, though, the Fed's looking at this, the markets are looking at this, knowing that, hey, inflation jumped up, jobs are still strong. Fed's not going to cut rates if both those things are happening. So that didn't go in our favor. Next thing we got was January starts and permits, and those came in down across the board. So again, this is new construction, permit starts, construction, and completed. As you can see, permits down 1.5% month over month, starts down 14.8%, construction down just slightly 0.2%, and completions were down 8.1%. And again, a lot of this is seasonal, but we know that permits, for instance, that 1.47 million annualized number, that's basically our future housing supply. That's both multifamily and housing. We know that housing demand right now is running closer to 1.9 million, 2 million. So we're still, almost 500,000 behind that. So we definitely need to build more to keep up with demand. But this is all good for current homeowners. The less we build, the less competition they have. But as you see here, the comment from the chief economist for the NHAB said, while housing starts decline in January, the NHB forecasts that single-family starts will rise about 5% this year. So that's good news for everybody. The more houses we build, the better. Next thing we got, January existing home sales. So that came out today. Those were up 3.1%, still down negative 1.7% year over year. And again, this is existing home sales that closed in January. They did a negative revision or a positive revision in December, or else this would have came in even higher at 5.8%, meaning the home price went up 5.1%. In inventory, we're up to about 1 million units, still way below what we need, like we talked about, still way below, the 2008 levels, about 4 million, slightly up month over month, 2%. We're still at only about 3 months supply, so it's not a normal market's more about 4.6 months. And the one that ticked up quite a bit, days on market, that's probably a little seasonal. People aren't looking necessarily to move in the middle of winter, so days on market ticked up from 29 to 36. And the other big tick up here was cash buyers from 29 to 32. So a lot of cash buyers jumping in, probably selling their homes elsewhere with a bunch of equity, having this money to come in and buy the home and not deal with someone like me and get a loan. Next thing this week we got today was initial job claims. And again, these came in really low. Estimate was going to be 218,000. They came in at 201,000. So like we talked about, job market still staying really strong, seemingly. Employers are trying really hard not to lay off employees, keep them employed. Continuing claims are still at really elevated levels, although they dropped this week. So again, the Fed's looking at this and saying, hey, the economy looks awesome to us. Speaking of the Fed, miscellaneous, we got the Fed minutes. So these are the minutes that are released from their meeting 3 weeks ago now. So again, this is dated information, and basically we already knew all this. All the different Fed speakers have talked since then, so we've heard all these talking points. So much ado about nothing, kind of what we expected. They definitely seem intent on cutting at some point this year. They just don't know when. And right now it's looking, I think it's this upcoming March meeting is at about a 5% chance they're going to cut. The May meeting, which was looking really good, now that's down to about, I believe, about 25% chance there'll be a cut. And so we don't really see it going in our favor until the June meeting, which is about 66% chance they'll have cut at some point by that point. So it keeps being, with some of this economic data coming out that, the expectations in the market for the Fed to, cut their rates sooner keep getting pushed further and further back. And then the average 30-year jumped from 7.03 for great borrowers to 7.16 according to this leverage survey. So going the wrong direction. Again, we kept pushing that 6.5 number, jumping back above 7. Again, this January, this PPI number really hurt us this week. Again, because that's backing up bad stuff for us. Inflation's still sticky, job market's still strong, and again, the Fed's going to look at that and rightfully say that maybe we don't need to cut yet. So important dates. Next Thursday is a really important one. That's the next inflation report, the PCE one. There could be some negative expectations going into that one because of this PPI. So they take some of the stuff out of this producer inflation and put in this PCE. So if this came in really hot, that might not set well for us going, for that report. So we'll have to keep a close eye on that. And after that, we get a BLS jobs report, another inflation, and then again, the Fed's next meeting is beginning of March. But keep in mind one thing, you really got to keep in mind, whether you're an agent dealing with borrowers or you're a borrower yourself, you're looking to buy, is that waiting right now. A lot of people are trying to want to wait for rates to come down. But right now, if you go to buy, you're able to get something like a seller credit. You're able to, work within a market where you're not getting 4 or 5 offers, 10 offers per place. And with that seller credit, we probably could buy the rate down, get the rate to a reasonable level. Whereas if you wait, 3 or 4 months from now, thinking rates are going to come down and you go to buy then, prices are probably going to be higher. And also, you might not be able to get that seller credit. So, today I actually might be able to get a lower rate for you, based on the market than you could get when rates are lower in a few months, just because how competitive we'll get at that point. So that's just something to keep in mind. Today's always the best day to buy a home. The longer you wait, usually the more expensive they get. So if you have any questions about that or anything at all this week, please don't hesitate to reach out. Otherwise, I'll talk to you guys next Thursday, and hopefully that inflation report comes in our favor. Have a great week, everybody.